Mid-caps see a notable recovery from the lows after a big slide, but declining stocks continue to outnumber advancing counters by a wide margin. Utilities, industrials and energy are the big drags, even as IT and FMCG remain relatively resilient.
The raft of business updates from prominent lenders, including the likes of IndusInd Bank, Federal Bank and Bandhan Bank, point to a rush for deposits, leading to a swelling of bulk deposits, even as loan growth is tempered.
Titan and Kalyan Jewellers report strong jewellery sales in the second quarter following the import duty cut on gold. Despite the inauspicious Shraddh period, most jewellers line up store expansions to ride the trend and anticipated festive growth.
State Bank of India has categorized its MTNL exposure as non-performing asset. The move comes amid reports of the government working on reviving its telecom arm. The bank warns of legal action in case of default. Hello and welcome to Halftime Report on CNBC-TV18. I'm Ekta Batra and with me is Mangalam Malu. Well, it's turning out to be another rough and tough day for us at this point in time, especially for the mid-cap. So the mid-cap index is down around 2%. Advanced decline ratio is extremely dismal at around 1:5. So around 680 odd stocks advancing to around over 3,400 stocks declining. So that's the picture which is showing up on the Bombay Stock Exchange. We have a lot of cues to watch out for over the rest of the week, such as the RBI policy, and we will be kicking off earnings as well. So Mangalam, a lot to watch out for, but nonetheless, today is definitely a weekday. The Nifty below 25,000.
The Nifty below 25,000. So many factors playing out in the market, right? And remember, on Friday, we got good cues coming in from the Wall Street. The Dow was at a record high, owing to a strong September jobs report. But all of that hasn't kept up the momentum for our markets. At high levels, we are seeing some selling, perhaps on account of a couple of factors. One, the Iran-Israel tensions continue. Secondly, the street is also factoring in the impact of the exit polls of the J&K and Haryana elections. And the third most important thing ahead of the RBI policy, we'll also keep an eye out on what takes place with the Chinese markets opening tomorrow. A big outperformance is what we've seen in China, but over the last 4 trading sessions, on an average, on a daily basis, we've seen the FIS sell about 10,000 crores in cash in particular. Hang Seng up about 1.1% of the previous trading. Just keep an eye out on how it opens tomorrow after a week-long holiday. Though a couple of stocks doing better than the other parts of the market, AU Small Finance Bank stands out on account of their second quarter performance update. LTI, Mindtree and Emphasis are doing a lot better than the other parts of the market, again on account of the brokerage upgrade that has come in from JP Morgan. And finally, we have Natco Pharma. That too is in focus, holding mildly in the green on the back of the settlement order that has come in the US patent case over generic Ozempic, the semaglutide drug that we're talking about. Ekta, how does this impact Natco and what explains this outperformance that we're seeing?
Well, yes, relative outperformance at this point in time, but nonetheless, that's because it has the magic word Ozempic or semaglutide, which is attached to it. So, like you mentioned, the news with regards to Mylan and Natco is that they have a partnership for semaglutide. Now, Mylan and Novo Nordisk, which is the innovator of the drug, which is the innovator of Ozempic, have reached a settlement in the US on the generic version of this particular drug. But the terms of the settlement are confidential. All we know is that Natco and Mylan have signed up for it. Now, according to Natco, in terms of the investor presentation, they have said that they are key sole first to file, which means under the para 4 for Ozempic in terms of the 8 mg and the 2 mg version. And they are key sole first to files for Wegovy in all strengths. So what does that mean is that they can have exclusivity, 6-month exclusivity, which is basically standard when you say first to file. Now, we don't know the details of the settlement, but that's what first to file means. Now, Ozempic, remember, is used for diabetes. It did sales of around $14 billion in 2023. It was up 66%, and it is estimated to close this year with $17 to $18 billion. Wegovy, which is used for weight loss, that's also semaglutide, which is the molecule. The global sales are $4.5 billion. Now, Natco has said that on Ozempic, they are sole FTF on some strengths and they have shared FTF on some strengths. But 50 to 60% of the market value for the diabetes indication, they say that they are sole FTF. So for Wegovy, 100% of it, they are sole FTF. Wow. For Ozempic, 50 to 60%, they are expected to be sole FTF. So Natco right now is awaiting approval for Ozempic generic. Mylan is also doing the strategy for the ex-US businesses. So based on the tie-up that they've had, they have said that major regulated market businesses will be handled by Mylan, and rest of the world businesses, Natco will have some rights when it comes to Ozempic and I'm assuming Wegovy. Natco and semaglutide in India, that will be interesting, Mangalam, because March 2026 is likely when the patent expiry is going to take place in India. And Natco hopes to be in the first wave of launches. The company is hoping regulatory approval should come by then. But nonetheless, that should probably really disrupt the domestic market and probably even push up sales for a lot of these companies.
All right, let's see how that comes about. But like you said, the magic word, semaglutide, or rather Ozempic, has the street excited about that. But, a couple of brokerages are excited about the prospects for LTI, Mindtree and Emphasis as well. Even as, the IT stocks are looked at as a place to hide in this sort of volatility that we have. There has been an upgrade coming in from JP Morgan on both these stocks. Nimesh joins in with more. Nimesh, is your standout brokerage of the morning. These stocks are outperforming in an otherwise wobbly market.
Absolutely. Both are buzzing in trade and on good volumes as well, the top gainers as far as F1 is concerned. Now, in both the names, JP Morgan has today upgraded both the stocks, L&T Mindtree and Emphasis, to overweight. On L&T Mindtree, they've raised the target price to 6,900. And on Emphasis, they've raised the target price to 3,400. Now, JP Morgan believes that both these companies are a proxy to the banking and financial services recovery plays. Now, they expect this is a vertical which has done well in the last couple of months. The commentary has been quite strong, especially from the US firms in the last 3 odd months. And again, with the Fed rate cut, the mortgages are also likely to improve in the US, which has been under pressure as well. Now, if that has to happen, both these companies could do well, because this will drive the overall discretionary tech spends over the next 12 to 18 months, and both these companies could be the biggest beneficiaries. Why I'm saying is because for both these companies, the BFSI segment contributes nearly 35% for L&T Mindtree and close to 60% for Emphasis, and hence both these could benefit. Now, the upgrade is largely on back of EPS upgrades as well as multiple upgrades as well, and hence both have been upgraded to overweight now by JP Morgan. And on L&T Mindtree, the new target is 6,900, and on Emphasis, the new target is 3,400.
Okay, and as you can see, LTI Mindtree is the top gain on the Nifty, up around 1.7% at this point in time. So doing well for that particular counter. We'll take a short break, but up next we'll connect with Ghulam Zia of Knight Frank India, as Q3 2024 reported its highest quarterly residential sales this year. Let's see whether the trend continues or not. Welcome back. Well, for the markets, it's weak. Mid-cap index is down around 1.7%. We have a lot of the companies which are under pressure from the real estate space. So Prestige Estates, for example, is down around 1.7% as we speak. And a couple of these PSU banks as well. So Bank of Maharashtra, for example, is down around 2%. So there's just a mix of stocks across sectors which are under pressure from the broader markets. And as you can see, that's reflected in the advanced decline ratio. But let's talk about the real estate space. Q3 2024 has recorded what is the highest quarterly sales this year at 87,108 units. Sales have grown across all markets except for the NCR region, where sales have dipped by 7%. To discuss this and more, we have Ghulam Zia, the Senior Executive Director at Knight Frank India, joining in. Ghulam, hi, welcome to the show. Well, all of this is back end. I mean, it's not really forward-looking data anymore, because Q3 2024, while it did record the highest quarterly sales ever this year, rather, are you seeing that trend continue? And the reason I'm asking is that, there's been some amount of uncertainty which has seeped into, say, the equity markets. There's some amount of uncertainty which is arising out of this entire geopolitical situation. So are people getting a little cautious in terms of expenditure, and is that already reflecting in the real estate space?
Thank you so much for having us on this show today. First of all, your concerns are valid. In fact, these concerns are airing all over. The pulling back of expenses is really something which we are looking all around. However, the same is not reflecting in the transaction numbers of residential sales yet. So at least last couple of months, people have been talking, albeit in a hushed up tone, that real estate sales, residential sales are going down, but the numbers are not yet showing that. As we said, if you just focus on the numbers of this quarter, as you rightly said, almost 10% growth YOY. And that number itself is going to be the best in last 10 to or 12 odd years. In 2012, we saw about 3.5 lakh apartments sold in a year in the top 8 markets. This year, we are poised to either equal or break that record. So while the concerns are there, the end to the residential sales is nowhere in sight. I would love to see a couple of more months, if not a quarter or two, before we convincingly talk about the trend. However, at the moment, the party continues.
At the moment, the party continues, but for how long, because now everyone's thinking of it as, having lasted for a lot longer than one was anticipating. So the question is, what next? I mean, with all these things happening around, and maybe, the equity market's also seeing a bit of a sell-off, so the wealth effect will start coming into picture as well. So from here on, what's your prognosis?
Let me just divide it into a certain sections. When we are looking at these numbers, these are essentially driven by the upper end of the market, which is, grown almost about 46% of the overall market, which used to be in single digits maybe about 3-4 years back. So the key point here is that mid to low end of the market is just not performing. And the reason of that was multifold. To start with, post-COVID, there was a huge distress in the lowermost segment. And after that, the home loan interest rate shoot up. These two things had a huge impact on the lowermost segment of the market. And then on the other side, from the supply side, because the developers realized that the margins and velocity of sales are much better in the upper end, everybody was focusing on the upper end of the market. So net, what happened is that all the transactions, most of them almost touching half of what is happening, is upwards of 1 crore and higher. And that is a concern. The mid to lower end of the market hasn't really been performing at all. And now with the Pradhan Mantri Awas Yojana 2.0, which focuses on bringing, lower interest rates by at least 150 to 200 bips for the lowermost segment of the market, here we are already looking at some expectations of improved transaction numbers down there. While it is not reflecting on the overall number, but we are expecting in times to come, in next couple of months or couple of quarters, when upper end of the market will dry up or at least go slow, the lower end will shoot up. And that is where, if the answer is so simple, I would say that I don't expect much of an impact on the real estate sector per se, because if one segment is been doing exceedingly well, the other segment is just about starting. So net, I'm not expecting this, the euphoria that you see in real estate market to die down for at least a year or two. With lower end of the market shooting up in next quarters, we will see much of an impact actually to cover up for the losses that you would see or the slowdown that you would see in the upper end taken over by the lower end of the market.
Okay, all right. Fair enough. But when you talk about pricing, then, while sales might not be impacted, do you think that pricing will probably stagnate across categories?
Well, pricing has been one of the problems that we are expecting to bounce, to actually haunt the real estate sector, especially in the mid to upper end. The price rise has been in a few markets like Mumbai, NCR, etc. The price rise has been absolutely not justifiable. The kind of numbers that we are always worried that if developers start jacking up their prices without really taking cognizance of the market realities, it will bounce back, it will hurt them a lot. And which is already we are reaching that stage. So you're right, the price rise that has happened in last year and a half or two was actually something which we are worried about, and now it will taper off. So if your concern or question is about whether do we see any improvement in price rise, definitely not. We would expect the prices to actually cool down a bit. And going forward, affordability will be under question, and hence developers will be smart enough to realize that velocity of sales is more important than keeping the prices high. So somewhere we do see the prices cooling off in the upper end of the market, but with lower end recovering, I would really expect that the prices would still not be that much of a problem in the lower end of the market.
All right, take that point. Always a pleasure speaking to you and hearing out your views on the real estate space. Wish to continue our conversation another time as well, post-festive season. Perhaps we'll do a demand check once again. Let's step into a short break now. And as we do that, let's give you some good news, which will appear right here in a moment. This one is for you, viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. What you do with this app is get instant access to all the breaking news and in-depth articles and everything that's taking place in the financial world, which you would normally see on your television screens, will now come on your fingertips as well. What do you have to do for that? Nothing. Just download this CNBC TV18 app from either the Apple Store or the Google Play Store and stay updated on the move. Welcome back. Good time to get in Manish Hathiramani's views on the index now. Manish, you've been talking about the Nifty, moves on the Nifty for a very long time. Right now, with a near 5% correction from the top, almost 1,000 points, a little around 1,200 points. Where do you see this going? What levels are the important ones to watch out for?
Good afternoon, Mangalam and Ekta. Thank you so much for having me on the show. Well, if you recall, Mangalam, when we were at the high point, there were certain resistance points that we had spoken about. Those did resist. We have turned around from there. Given the current situation, I'm working with a very, very specific figure, which is 24,940, which is Friday's low. Thereabouts about 20, 30 points. I feel that's a very crucial level that we have to watch out for. If we are unable to close at that level, and we end up closing below that level, I feel we can see a further slide of another 500 points.
Okay, all right. And stocks?
Stock perspective, I'm working with two sell calls. My first one is on Reliance for a target of 2650, stop loss of 2850. 2850 to 3050 was a sideways zones on the daily charts, and we have broken that with good volumes. This makes Reliance a sell candidate. The second one is on Adani Ports for a target of 1250, stop loss 1430. This stock has actually broken down on large volumes while it was disrespecting the supports of 1430 and 1390.
All right, you're looking to sell Reliance and Adani Ports. Reliance in particular, quite a heavyweight on the index. So it looks like maybe, that your 24,940 level would also be under threat if one is looking to go short on Reliance.
Well, Mangalam, if you look at today's data, you did break 940. We've gone up a couple of times. If you look at the market right now, while we speak, we are at 24,933, which is still trying its level best to really break that 940. But what I'm keen on seeing is that are we able to close below 940 or not? If we do not close below 940, this could well be a bottom and you can see some kind of trickles or bounce backs. But if we do break, then any kind of up move will be looked at as a selling situation.
All right, take that point. Thank you so much for joining in. Good time to also look at, what's happening in the F&O pack as well. If you just look at the intraday charts of both the Nifty as well as the Nifty Bank, you would see a fair amount of volatility. I mean, volatility is the only way to explain this market. We opened fairly well. Thereafter, there was a sharp dip. Then there was a recovery. That recovery was sold into, and currently as well we are hovering around the lower end of today's trading range for both the Nifty as well as the Nifty Bank. And understandably, the India VIX has showcased that with a jump of almost 5% after a big jump of nearly 30-35% that we've seen in all of last week. Off the record high, we have the Nifty Bank down about 5-6% each. The mid cap and the small cap indices have it much worse. And even today, the pain is largely in the broader market, so portfolios would be feeling the hurt. 2,200 stocks which are declining for just about 260 stocks which are in the green right now. And the BSE circuit summary, if you look at it, 186 stocks are in upper circuit. Compare that to stocks in lower circuit are 545. The interesting data here is that none of these A group or B group investable stocks are in upper circuit, telling you that all the decent quality stocks are way off upper circuit, and 545 of them are actually in lower circuit itself. For the Nifty, the markers are pretty clear. 24,900 put is extremely active today, and on the way up, 25,100 call as well. So 25 100 call has seen some writing. At the lower level, maybe 24,650 to 24,700 is a support that the street is eyeing, at least in the very near term. But there are a lot of triggers to track as well in the very near term. We have the Iran-Israel tensions, which are still underway. We're looking at China reopening tomorrow, and then we have the RBI policy meet this week. So all these factors leading into the second quarter result season is something that we will be keeping an eye out on. Take a short break, come back, tell you more on the markets and a lot of individual stocks on the other side.
Welcome back. Well, week for the markets as yet. So we have the mid-cap index, which is still down around 1.8%. The bank Nifty has been quite volatile today, so it's down around 325 odd points as we speak. And we have the Nifty, which is still under pressure, so below 25,000. 24,896 is currently where the Nifty is. But the market, as it continues to be volatile today, where exactly is it headed? Money Control has asked a bunch of market experts and conducted a poll with some key questions. Vinny Motiwala is standing by with the top takeaways from this poll. Vinny.
Good afternoon. Yes, in terms of the latest findings that we're seeing coming in from the Money Control's expert poll on Indian markets, indicating that it's currently seen as expensive. Experts are forecasting a potential 10% correction that one could be still watching out for from the current levels. And this is despite the recent high correction that we've seen for the Nifty as well as the Sensex. Now, let's look at what are the key questions that were asked to these experts. The first one was in terms of the geopolitical tensions. Current scenario over there, plus China that is coming back, the stimulus that is given, is that worrisome? So yes, what is coming in is 52% of these experts actually believe that, yes, the current rising stemming issues in terms of geopolitical tensions and the China coming back and making a recovery, that would be more worrisome than the past events that one is watched out for. The second big question is in terms of the risk that currently the Indian markets are facing today. Which of them is the biggest risk? Now, in that, 54% of people actually highlighted that experts said that high valuation is a big concern for the Indian market, and they have been overvalued is what the word is coming in. So following the next one is in terms of earnings disappointment. That could be a big concern and worry as the risk in terms for the Indian markets going forward. And lastly, geopolitical tensions. Obviously, it's an important concern coming in, but that's taken a bit of a backseat. 20% people believe that only that would be a main worry coming in. So yes, keeping an eye on that. Moving on to the third question, we also have everyone who's closely watching out for where will the Nifty be ending in the calendar year 2024. So 16% of people actually believe that 23,000 below that level, only 16% believe. The highest range that we're seeing coming in is from 25,000 to 27,000, where a majority of experts believe that this is the range in which the Nifty could potentially see an end coming in, while above 27,000, slightly bit more optimistic, but very few over there, just a 4% mark that we're watching out for. Let's move on to the next question that we have is in terms of deployment of cash. Where should one be investing their money? In the past, we've seen that mid and small cap rally, but now seems like experts believe that 76% of them would be looking at large caps. Let's not forget the sentiment is quite weak. Outlook is taking a bit of a beating. So it seems like experts will be looking at large caps versus the small and mid cap. And lastly, in terms of the question that we are watching out for as well is as many as 64% of the experts believe that Indian markets are currently expensive. We've spoken about this time and again as well, and that is what these experts are highlighting. While 36% believe they're reasonable, there was an option given that is it cheap? None of them actually believed in that option. So very expensive, and that is why, maybe we could be seeing a correction coming in the markets.
Okay, all right, Vinny, thanks very much for that. So that's an interesting poll coming in there. And the majority think that, the markets are expensive at this point in time. They would probably look at large caps versus broader markets now. But Mangalam, you're looking at Nestle. There's been a leadership change after over 2 decades.
After 2 decades. In fact, after a decade,
yeah.
from Suresh Narayanan's leadership. So if you just look at a couple of things, in FMCG companies, typically wealth creation happens the most amount of delta when there is a leadership change. We've seen that in the likes of Britannia. We've seen that with Nestle as well, where Suresh Narayanan took over, or Pidilite, where Bharat Puri took over, etc. as well. So now it's for the first time, if I remember correctly, that the company has gotten an external candidate to lead the India business. So Nestle has gone ahead and appointed Manish Tiwari as MD effective 1st August 2025. Why is that? Because Suresh Narayanan, his term ends in July 2025. So he retires with effect from July 31st, 2025 after having a stellar 26-year-long career with the company itself. What was Manish Tiwari doing, or what is he doing before leading Nestle? He is the country manager at Amazon India. He had been with Unilever for 20 years before Amazon as well, so does bring in the leadership chops, and at the same time reinforces the theory of Unilever actually being a CEO factory as well, because Suresh Narayanan too is an alumnus of the Unilever factory too. Manish Tiwari obviously is an MBA from IIM Bangalore, so brings in both the credentials, the experience to lead the company. So it will be interesting to see how he grows the digital vertical and category growth of Nestle at a time when the consumer sentiment is weak itself. And Nestle has seen a fair amount of crisis, for which Suresh Narayanan was the man, because he joined the company as the leader in August 2015 in India in the middle of Maggi crisis, led and grew the company through not only the Maggi crisis, but also demonetization, GST implementation, and the biggest of them all, COVID. And under his tenure, from the time he joined in the middle of the crisis to the trailing 12 months, the sales of the company have increased by 150%, EBITDA has increased by 300%, margins have improved by 500 basis points, and the net profit has grown nearly 6-fold. As a result of which, the street has rewarded Nestle. The market cap of Nestle on an already high base has actually grown nearly 5 times under his tenure in the last 10 years. So we wish Suresh Narayanan all the best for the second innings of his career. He has told us that, he would like to teach in the second innings of his career by giving back to society. But more importantly, all eyes will now be on Manish Tiwari, especially because it's the first time an external candidate has been brought about to lead Nestle. Typically, a big inflection point for any FMCG company when the leadership change happens, and also a lot of wealth creation opportunity. Let's see how Manish goes ahead and grapples with these challenges.
Okay, all right. So that's on Nestle. Thanks, Mangalam, for that leadership change taking place there. And an outside candidate, so that'll be interesting to watch. We'll take a short break, but a lot more on the markets and specific stocks. Stay tuned. Welcome back. Well, let's focus on Jupiter Lifeline from the hospital space. The stock has surged 27% in 2024. And ICICI Securities has initiated an ad rating on the company. It aims to double bed capacity to 2,500 beds over the next 3 to 4 years. We have Ankit Thakkar joining in to discuss the business operations with us and, a couple of targets as well, if he can share it with us. Ankit, hi, welcome to the show. Well, just wanted to start with the fact that, the company has this particular niche that it operates in, where it focuses on these micro markets, which is particularly in the western part of the country. And you look at, well-insured population, which is underserved when it comes to healthcare. Give us a sense in terms of whether you're looking to expand this strategy, when it comes to other states across the country, or are you going to be limited to the western part?
So currently, we are focused on the western part of the country. We see two reasons to do that. A, there's a lot of opportunity still in the west. It is grossly underserved in our analysis. And two, we also see significant merits to a concentrated region strategy in terms of operations and expansion both. So for the time being, we are focused on the west. But in terms of scalability and the fundamental thought process and strategy, nothing really changes. This model is not something which will only work in the west, but as far as our focus is concerned, it's west for now.
All right, your focus is west for now. What about business in the very near term? Of course, the third quarter will be seasonally weak because due to festive seasons, there aren't a lot of elective things that happen. But for the entire year, what's the kind of occupancy that you're guiding for and the improvement in average revenues per occupied bed?
So currently we are operating 3 hospitals, and 2 of them, Pune and Indore, still have a significant headroom for occupancy growth. We are in mid 60%, I think, in Pune, and Indore we were just approaching 60%, but now we are adding more beds. So we are adding about 75-80 odd beds, which should be ready in the next quarter, which will help us to again, have more capacity, which we can utilize for occupancy expansion. On the ARPOB side, there will be predominantly inflation-linked ARPOB growth in all the units. Indore will have a little bit more scope with better case mix going forward. That should be the ARPOB story.
Okay, so you're expecting good amount of inflation-linked ARPOB growth at this point in time. You do have a lot of this capex coming up, 2,200 to 2,500 beds. How exactly are you planning to fund it?
So we still have some cash on our books. We are still sitting on about 300 odd crores on our books, and we are doing greenfield projects. We are not doing an M&A activity. So the cash has to be gradually deployed over the next 3 to 4 years. So our internal accruals, which we'll generate over the next few years, along with our cash reserves, we believe should be largely sufficient for our current expansion activity. But also we have become debt-free after our IPO for the last 1 year. So if necessary and if there's a good opportunity, we are also open to taking some debt to fund that.
All right, Amit, Ankit, thank you so much for joining in and giving us your view in the very near term. Short discussion, but of course, we'll keep coming back to you as and when we get updates on the business itself. Take a short break, come back. On the other side, we have Manisha Gupta joining in with MJ Khan, who's the chairperson at ICFA. Stay tuned.
Welcome back. Well, Manisha Gupta, commodities editor, caught up with MJ Khan, chairman of the Indian Chamber of Food and Agriculture. Let's listen in to what he had to say.
I believe that this will be the first time, or not so often happens, that bumper crop does not result to crash in prices. So this time probably prices will also be maintained. So more yields, more production, more happy farmers and more happy country.
Would you say, Lyle, of course, a lot has been done and we've seen government take away some restrictions, whether it has been ahead of festivals, ahead of the Kharif crop, or important state elections as well coming in. One, how would you look at the government restrictions being taken away? And what would you suggest on what really needs to be done as in a point 1, 2 and 3 within agriculture for a medium term to long term?
I believe that government must not apply the restrictions. First of all, taking away is not a happy situation. At the first instant, it should not be applied at all. Why? If government anticipates, and today the IT tools are available through which we can see more precisely the future situation. So predictions are more, even the sowing intention survey can be captured today the way it is done in US. So it is possible to see that what is going to be. And there are many other parameters by which IT tools can precisely predict or extrapolate the situation. So restrictions should not be applied. Even if there is a shortfall expected, government must import that much at higher cost. So instead of subsidizing other things, it can subsidize the imports to maintain the prices here, but not to give jerk to the trade. So restriction is not a good thing. So whatever temporary measures of applying the restrictions and lifting that before the election times or the other festival seasons is not a healthy thing. It's not an indication of a long-term sound policy decisions. So this is my first say. In agriculture, there are many things to be done, looking at the reducing the cost of production to improving the quality in order to be more competitive at the global marketplace, because today we are in the trade about 2% of our share in the global trade, but in agriculture by value terms we are close to 9%, 8.5 to 9. So from here we have to go more.
A long way.
Correct. So every 1% increase will actually give extra trade of about rupees 60,000 crores or so. So therefore, from 2% the current share, if you go to 3%, one can add 60,000 to 70,000 crore more to the overall trade. So there's a long way to go and a lot of opportunity in the process. So government has to increase that. To tap that, what all is to be done, that we need to discuss. One of that thing is that through precision agriculture, we need to improve the quality and reduce the cost in order to become more competitive at the global market.
You know, a couple of other things that I remember you talking to us. One, of course, has been commodity boards. Where do you think that is stuck? Do commodity industries need a stronger representation when it comes to that? And the second thing is about the GMO. That conversation also has been on for some time now. So when it comes to both of these subjects, what is your views?
I believe given the dynamics involved in the approvals of GMO, so all the broad indicators are going to be in its favor, whether it is the concerns on account of exports. So Europe is not accounting that much, and rest of the world is going to account more, and the destinations, if we look at it, is increasing. So therefore, from that perspective also, and from domestic consumption and demand pattern perspective also, and then world over, there are many countries, Brazil and US, they are enjoying the benefits of that. Importantly, the technology breakthroughs are not happening in many crops. So scientists are seeing GMO as one of the surest kind of, this thing to achieve that. And industry and scientists both are on board on that. Government is inclined to that, given the opportunity that it throws up. So I believe sooner or later, in fact sooner, this GMO is going to be a reality in this country. Europe is not in a position to actually have its say through in terms of influencing the policies here. US has more, that's where the India is inclined to. So this is the one reality that we all see coming a little sooner.